It's the 14th of the month, and Ryan is standing in the grocery store checkout line with a cart that has maybe 20 items in it. Eggs, bread, a rotisserie chicken, the good trash bags because the cheap ones keep splitting. And he is doing the math in his head before the cashier even starts scanning, because Ryan has been doing this math in his head for 3 years now. He makes $72,000 a year. He got a raise last March. He has no boat, no gambling problem, no secret second family in another state, and somehow every single month, around the 14th or the 15th, the checking account gets thin enough to make him sweat a little in a grocery store. The cashier reads the total. Ryan taps his card. He doesn't even look at the screen. He already knows it went through. Barely. My name is Shazi, and if you've ever made decent money and still felt broke by the middle of the month, this video is going to show you exactly why. Not the vague stop buying lattes version, the real version, with real numbers, and a name for the thing that's actually eating your paycheck, because it has a name and it is not you. Here's the thing they tell you. If you just make more money, the problem goes away. And for a lot of people in their 30s and 40s, that's the promise they've been chasing. Get the raise, get the promotion, get to $70,000, then $80,000, then 6 figures, and somewhere in there, the anxiety disappears. The checking account gets comfortable, the math gets easy. Except it doesn't. And if you've already lived through a raise or two and thought to yourself, where did it go? You already know what I'm about to say. The median household income in the United States right now sits around $80,000. That's the number in the middle. Half the country makes less, half makes more. And according to every personal finance article ever written, $80,000 should be more than enough. You should have a funded emergency fund, a maxed IRA, and money left over. The math works on paper. People are showing you the spreadsheet. Spend 50% on needs, 30% on wants, 20% on savings. Simple. Clean. Completely untethered from how any actual person in 2026 lives. Because here is what nobody puts in the spreadsheet. Pause the video right now. I mean it this time. Open your banking app. Look at your last 30 days of transactions. Don't look at what you spent. Look at what you owe before you spend anything. Add up every payment that hits automatically before you even get to make a choice. Your rent or mortgage, your car payment, your insurance, your phone, your streaming subscriptions, your minimum card payments. Add up the total. Write that number down. Then look at what's left. That number that's left is what you actually run your life on. And for most people running a middle-class life in 2026, that number is a lot smaller than they expected. I'll show you why in a second, but first, I need you to find out which category you are in. Because not everyone is behind for the same reason, and the fix depends on where the leak actually is. Here is the paycheck scoreboard for 2026. If your fixed monthly obligations eat more than 60% of your take-home pay before you make a single choice, you are in the red zone. You are not overspending, you are overcommitted. The game was lost before the month started. If your fixed costs are between 50 and 60%, you are in the yellow zone. Technically survivable, one surprise away from a bad month. If you're under 50%, you are in the green zone. You have margin. Whether you're using it right is a different question. Most people guess they're in the yellow. Most people are actually in the red and don't know it yet. Now let me show you Ryan's actual math. Ryan earns $72,000 a year. That sounds like a lot. After federal taxes, state taxes, and his health insurance premium, $72,000 becomes about $4,600 a month that actually lands in his account. Not $6,000, not $5,500, $4,600. That first invisible cut happens before Ryan sees a dollar, and almost nobody talks about it. From that $4,600, Ryan's rent is $1,650. That's not a luxury apartment. That's a 2-bedroom in a mid-sized city. Gone. Car payment, $487 a month, because he bought a used car 3 years ago when rates were already climbing and the lot had exactly 4 options under $30,000. Gone. Car insurance on top of that, $190 a month. Gone. Phone bill, $85. Internet, $70. Streaming services he keeps meaning to cancel, $63. Gone. Minimum payment on the one credit card he used when the transmission died, $145. Gone. Ryan hasn't bought a single thing yet. His fixed obligations are $2,690 a month. That's 58% of his take-home pay, gone before he opens his eyes on the first of the month. He's in the yellow zone, almost red, and he didn't make a single bad decision to get there. $1,910 left for everything else. Groceries, gas, every dinner out, clothes, his kid stuff, the dentist visit he's been postponing, any car repair, any medical bill, any gift for any person in his life for the next 12 months. The fun that makes life feel like a life, and anything at all towards saving for the future. $1,910. And now you understand the grocery store. Here's where I need to rehook you, because what I just showed you is the symptom. Here is the disease. The reason Ryan's fixed costs eat 58% of his take-home pay is not because Ryan is bad at math. It's because of something that happened to the structure of a middle-class budget over the last 20 years, and nobody sent a memo about it when it changed. In 2005, a middle-class family spent roughly 50% of their income on the big three: housing, transportation, and food. Those three categories. Today, the same family, same income adjusted for inflation, same basic life, spends closer to 65 to 70% on those same three things. The big three ate an extra 15 to 20 cents out of every dollar, and the other stuff in your budget did not shrink to make room for it. The cable bill became 6 streaming services. The flip phone became a $1,200 smartphone on a payment plan. The employer-covered health plan became a plan where you pay a premium, a deductible, and a copay, all of which went up every year for a decade, and nobody voted on it. Your expenses didn't grow because you got reckless. They grew because every single category they live in got more expensive faster than your income did. Read that again. The expenses didn't outgrow your discipline, they outgrew your income. And there's a specific mechanic behind this that makes it almost impossible to notice while it's happening. I need to tell you about what economists call lifestyle maintenance inflation, but I'm going to call it what it actually feels like, which is the floor rising. Think about it this way. The car you drive is not a luxury, but the average new car in 2026 costs over $48,000. The average car payment on a new vehicle is over $700 a month. People are not buying these cars because they're frivolous. They're buying them because the used car market got destroyed by supply chain problems and hasn't fully recovered, because the car they needed to replace was unreliable, and because the dealership offered financing that made $700 a month feel more manageable than it is. The floor on what a car costs rose, not because you have worse values than your parents, because the inventory was different when you showed up to buy one. Same story with housing. The median home price in America is around $415,000. If Ryan wanted to buy the median house, his mortgage payment alone at current rates would run him around $2,400 a month. That's 52% of his entire take-home, before insurance, before property tax. And renting isn't cheaper in most markets. Ryan's $1,650 rent reflects 2 bidding wars he lost before he finally got this apartment. The floor rose. Transportation rose, housing rose, healthcare rose, education rose, and the part that makes you feel like the crazy one is that your paycheck technically went up too, but the paycheck went up 3% and the floor went up 7%, and every year that gap compounded quietly into the thing Ryan feels every time he's standing in the grocery store doing subtraction in his head. Let me show you where it gets worse, because it does get worse. There is a second category of paycheck drain that is harder to see than rent or car payments because it doesn't show up as a line item. It shows up as the absence of something. Behavioral economists call it the payment decoupling effect. Here's what it means in English. When you swipe a card, instead of handing over cash, you spend on average 12 to 18% more on the same purchase. When you set up autopay, you lose track of what you're paying altogether. When you use buy now, pay later, you buy things you would not buy if you had to pay for them today. The technology that was supposed to make money easier to manage made it easier to spend without feeling the spend. Ryan has 11 recurring subscriptions. He named 4 of them when I asked. He pays $287 a month for things he has largely forgotten he signed up for. That's $3,444 a year, invisible, gone. Not because Ryan is careless, because the entire subscription economy is engineered to exit your awareness as fast as possible. The first charge is intentional. Every charge after that is inertia. That's not a character flaw. That's a product strategy. And then there is the credit card. Not the big purchase on the card, the small ones. The $47 here, the $23 there. The coffee, the lunch, the Amazon order at 11 p.m. Research from Intuit shows that the average American underestimates their discretionary spending by 40% when they try to guess it without looking. They think they spend $300 a month on eating out. The bank statement says $510. They think they spend $80 on entertainment. The statement says $180. Not because they're liars, because they literally did not feel the money leave. The dopamine hit was real. The cost did not register the same way. Ryan thinks he spends $400 a month on discretionary things. His last 30-day statement says $650. That $250 gap is compounding on a credit card at 24% interest. Read that again. He's paying 24% interest to fund the gap between what he thinks he spends and what he actually spends. Now, here's the part where I tell you about the Garcas. Marco and Elena Garza make $95,000 a year combined. By every measure, they should be fine. 2 incomes, reasonable rent in a market that hasn't fully gone insane yet, 2 cars that are paid off or close to it, and by the 15th of the month, Elena is transferring $200 from savings to checking because something always happens. Something always happens. The car needs tires. The kid needs cleats. The copay from the urgent care visit last Tuesday. It is always something, and the something is always $200 to $500, and it is always exactly enough to erase whatever buffer they had. What's happening to the Garcas is not a spending problem, it's a savings architecture problem. They have no emergency fund. They have a checking account surplus that they treat like an emergency fund, which means the first time the account gets low, a real emergency has nowhere to land except a credit card. And the credit card now has an $1,800 balance from the last 3 emergencies that had nowhere to land. And that $1,800 at 22% interest is costing them $396 a year in interest payments for the privilege of borrowing from themselves in a panic. The Garcas are not behind on retirement because they don't care about retirement. They're behind on retirement because the mechanism that should catch surprises is broken, so every surprise goes on the card, and the card costs them money. And the money that costs them compounds backward into less available to save, which means the next surprise also goes on the card. It's not a lack of discipline. It's an architecture leak that feeds every other leak. Here's where it gets stupid, and I mean that sincerely, because the solution is genuinely boring. Boring to the point where I am almost annoyed that it works, but it does work. The reason Ryan is sweating in the grocery store on the 14th is because of the sequence. He earns, he pays his fixed costs, and then he spends what's left, and then he tries to save what survives after all of that. That sequence is the problem, not the amount, the sequence. Every study on savings behavior in the last 20 years points to the same thing. People who save automatically before they can spend it save significantly more than people who try to save what's left. The difference isn't willpower, it's architecture. If the money is already gone before it lands in the visible account, you adapt to what you see. Your brain recalibrates to the new floor. You spend less automatically because there is less to spend. This is what Ryan needs to do, and it's one move. Before Ryan sees his paycheck, before he can think about what to do with it, he needs to route 2 numbers out of the top. First, his emergency fund target. If Ryan has less than $3,000 in a separate savings account that he does not touch, he needs to put $200 a month there automatically from the day his paycheck hits until he has 1 month of expenses covered. Not a giant scary number, 1 month. Roughly $4,600 for Ryan. Then he adds a second month. Then he stops until the rest of the plan is running. Second, his retirement contribution. Ryan is already doing 3% into his 401k because his company matches it and he knew that much. He needs to go to 6% this week. That one change, going from 3 to 6, will cost Ryan about $110 a month in take-home because the pre-tax effect reduces the bite. And over 15 years at a reasonable long-term return, that $110 difference becomes somewhere in the range of $60,000 to $80,000 more in his retirement account. $110 a month, $60,000 to $80,000. That is not a typo. And for the Garkas, the one move is the emergency fund, full stop. They don't need a budget overhaul, they don't need to cancel all their subscriptions at once. They need one auto transfer of $300 a month into a high-yield savings account they cannot easily access until they have $5,000 sitting there. Because once that cushion exists, the next surprise doesn't go on the card. The card stops growing, the interest stops compounding, and suddenly they have $396 a year available that used to disappear silently into the balance. Architecture fixes the leak that willpower can't. Now, here is where I want you to picture Ryan again, except it's 3 years from now. He ran that same sequence change. He auto-drafted the emergency fund until it hit $5,000. He bumped the 401k contribution to 6%. He went through his subscriptions one Saturday morning, canceled 4 of them in 22 minutes, and recovered $140 a month and set half of that toward the credit card. He didn't become a monk. He still goes out, he still has fun, but the sequence changed and the architecture changed. And when he's standing in the grocery store on the 14th now, he doesn't do the math in his head because he already knows the answer. The account is fine. Not because his income changed, because the order changed. So here's where you actually stand. If your fixed costs are eating more than 60% of your take-home before you make a single choice, you are not failing, you are overcommitted. And the fix is a ceiling, not a budget. If you have less than 1 month of expenses in an untouchable account, every surprise will keep landing on a card and compounding backward. And the only fix is the auto transfer you set up this week. If you're paying interest on a credit card right now, the highest return investment you have available today is not a stock, it's the card balance. Paying off 24% interest is better than any index fund, guaranteed. And if you find yourself doing the math in your head in a grocery store on the 14th, you are not behind because you're weak. You're behind because nobody told you the sequence was broken, and the floor kept rising, and the subscriptions were engineered to exit your awareness, and the card was designed to decouple the feeling from the spending. The paycheck didn't fail you. The architecture did. And architecture can be changed on a Tuesday morning before you're even fully awake. Drop a comment and tell me which zone you landed in from the scoreboard at the start, red, yellow, or green. And tell me the one fixed cost that surprised you the most when you actually added it up. I read them. If this video helped you name the thing that's been draining you, subscribe, because that's what we do here every week. Name the thing, show the real number, hand you something you can actually do. One last thing, and you already know I'm going to say it. I'm not a financial advisor, and nothing in this video is financial advice. It's just patterns and real numbers, and you're smart enough to decide what applies to your life. I'll see you in the next one.